Hello and welcome to Securities Lending Saturday. I'm Roy Zimmerhansl. I'm your host, and today we're going to be doing a review of the first 4 months of the year, securities lending revenues and other related data. So if securities lending is your thing, if you are a lender, a borrower, part of the infrastructure, or just plain interested, then this is the place for you. So let's get started. Hi, everyone. I'm Roy Zimmerhansl, as I said, and today on this beautiful Saturday, which is sunny as well, we're going to be talking about numbers. This is in response to a question I was asked by one of the viewers just to do a review of the top 10 securities. So I have that and more for you. So without any further ado, I hope you're having a great Saturday. Thanks very much for anyone that's joining me live. Hello to everyone that's joining us on the replay. What we're going to be talking about first 4 months of the year and revenues. And that's what it's all about. We aren't in this for fun and games, although the business is a fun business. Used to be more fun, but I won't go into that. But here we go. So this is week 46 out of, let's see, last 48 weeks. I've missed 2 weeks. Today, talking about the latest market. Next week, I'm going to be moderating a panel at the Securities Finance Technology Symposium. I'm running a panel on liquidity and trading, great group of panelists, but there are other panels on the day as well. And next week, my plan is to be able to give you some feedback from the conference event. The reality is you can attend it yourself. It's free. If you go to the comments, the community segment on my YouTube channel, then you'll actually be able to see where you can go for registration on that. Let me just quickly put up the YouTube channel destination because that's where you find the recording. But today, right now, you will be able to see in the community part, the community page on my channel, you'll see a link as to where you can register for that Securities Finance Technology Symposium this week on Thursday, and it's free to join. Okay. As always, what we have is information, and hopefully it's a little bit educational and sometimes entertaining. As I said, I'm going to be talking about the year, so January, February, March, April, but also just quickly go through the top 10 stocks. In fact, it's not even the top 10 stocks. I guess it is. It's the top 10 revenue generators. A couple of them are exchange traded products, so they are in fact shares, even though they represent corporate bonds, which is an interesting story all year long. Now, as I said, all of the data that I'll be using or basing my comments on has been published. You can get this publicly available on the IHS Market website, which is now part of S&P Global. I want to thank them for making that information publicly available, but also the top 10 list they provided to me, and I appreciate that, and I'll be showing it to you. Okay. As always, hopefully the video is helpful to you and interesting. I've had quite a lot of good comments on that this week from new viewers who have found individual videos good. So that's really pleased to hear that. That's why I do it. Of course, if you want to make certain that you get all of the subsequent videos and everything, you need to make certain that you subscribe, which I can't get to subscribe. There we go. Let's do that. Now you can see how you subscribe. You just go to the YouTube page where I gave you the channel a minute ago and hit the subscribe. And if you also hit that little bell, it'll let you know every time I post a new video. So let's go to the meat of what we're talking about here. Let's start with January. Started the year a little bit slow, to be honest. $836 million of revenue. That was down 15% year on year, which I think is just incredible. It shows how dreadful the year started, because when you do a year-on-year comparison, you're also talking about a time when Korea was out of the market. Short selling was still banned at that time, and Korea is always one of the top performing markets. And the fact, even without including Korea last January, you had a huge drop off in comparison to the bigger numbers that were produced last year. Now, Of course, if you remember, though, there were a couple things going on back then: GameStop and SPAC. So, just to show you this chart here, right? This is GameStop, and what an incredible spike at the end of January, which of course generated a huge amount of activity. There was a lot of short activity on there. Of course, since fees are tied to the value of the asset on loan, when you have a skyrocketing asset value, the fees also go up. Even if it only goes up for a day or two or a week, that has a huge impact. And that was the last week of January where that huge spike happened. Of course, it remained particularly elevated for some time. So the reality was there were quite a lot of short positions in there, but also SPACs were a huge contributor to revenues throughout most of the year. So again, it's a little bit of a tough comparator year for January, but still, I think that was a surprisingly poor start to the year. Now, the interesting thing, though, is that's just from a revenue point of view. That's not an activity point of view, because the reality is balances were up. If you look at the chart on the right, you can see the balances in every category except ADRs was significantly up over the year. So what does that tell you? To me, one of the things that I've always talked about is, if you are in a continuously rising bull market, the nature of the shorting activity changes over time. And so the longer that continues, the more that what you have is there's a difference between people shorting, the objective behind that. Some is directional, where they're trying to make money from that. Some is price dislocation between similar assets. And some of it is just outright hedging. And so to me, when I see a long-term bull market, I think that's great for balances and not so good for revenues, because in a rising market, everything is rising, including rubbish stocks. And so it's hard to bet against rubbish stocks in an overall rising market. And that's why short sellers have a hard time at periods of time. So what happens is the nature of the shorting starts to move into the hedging side of things, where people are saying, look, my portfolio is just growing and growing. And what I really need to do is protect myself against a fall in the overall market rather than specific securities as I hold. And so the truth is, the demand for large cap, blue chip, widely available general collateral, as we call it in the parlance of the industry, uh, grows, right? Less about specials, more about the big cap stocks. Now, of course, the big cap stocks are impacted by a normal supply and demand. So since there is such a huge supply of all the largest cap stocks available for loan, the fees they generate are lower. So you can have a situation in all of these regions where you're talking about main index names increasing the amount on loan without it necessarily increasing the revenues. And in fact, as we see, the revenues are down in almost all of those sectors, with the exception of Asia. Okay. What we went into the beginning of the year was, although markets had come off a little bit from all-time highs, they were still flirting with near-term highs. And so it was really more about a head basis than anything else. So balances up, revenues down. A couple of interesting stories here. Corporate bonds up 100% year on year in terms of revenues, right? That's all part of the rising interest rate expectations. And interestingly, there's an overlap on the corporate bonds and the exchange traded products, because 3 of the top 5 exchange traded products were also corporate bonds. So what we see is a growing bet on corporate bonds being challenged. Again, the bonds that they will have issued in over the last sort of 3, 5, 7, 10 years will have been at very low interest rates. When you get rising interest rates, those bonds become less attractive. They're likely to fall in value throughout the life of the bond. Again, at maturity level, they go back to the regular rates, or go back to par, and everything's fine as long as they don't default. So you see a lot of bets against those bonds. That's been a theme all through the year. Now, in terms of individual regional revenues, I'll give this to you for each of the months so you can see how they track. So Asia Pacific if you look at it, $175 million from that region, which was up 37% year on year. So not really all that far off from the Americas, so the US and Canada and Mexico. So Asia Pacific, a huge start to the year. And again, that's without Korea being part of it. Europe being kind of the laggard here with around 80 million. It's been a tough year for European equity lending. So then if you go into February, we see that the month-on-month revenue is a little bit down from January, but of course, February has 3 fewer days. So I think the actual figures is January is around 26 million a day, and in February it's just under 30 million a day. So you can see the revenue story is growing year on year. That's a 2% increase. So that actually is a pretty big lift over February last year when you take into account that GameStop and the other meme stocks were still having a big impact. What we saw was the balances are up again, and this time it's with a slight revenue rise. Remember, GameStop was a high fee stock. The other meme stocks were also high revenue generating stocks. So the fee levels were very high. Whereas still in February, still people are clinging on to this sort of hedging rather than necessarily a specials driven market. You see the US and Canada and the rest of North America recovering. So 305 million, up about 40 million from the previous month and up on the previous year to date. But again, fee levels down 14% while balances were up 22%. So you can see again, like a really strong bias towards more stocks, but ones that are actually paying lower fee or that cost lower to borrow. So more of a shift again away from specials, away from hard to borrow stocks and into the general collateral side of things. Asia Pacific, again, another strong month, 37% up year on year. Again, ex Korea. Europe, even lower than January. But again, balances up, main index blue chip names, but fees down 16%. So that's pretty fundamental shift away from specials trading activity. Corporate bonds, again, continues that kind of 100% plus year on year figure. And exchange traded products, mention the rising interest rates again, and the exchange traded products, all-time revenue high, generated 70 million in the month. These are the top stocks in the US for the month of February. Have a look at that. You can see the quantum of how much they're generating. So I put this up to show you that this one stock generated 26 million. Lucid's been a good name all year, and some of these others are common. Sirius has been up there for forever. But I wanted to contrast that with exchange traded products, which, as I said, hit an all-time high that month. But look, you've got a high yield corporate bond fund, an investment grade corporate bond fund, right, in this month, and then a different index based high yield bond fund. So 3 of the top 5. The ARC ETF is taken quite a beating in the year after having a phenomenal time before that. Inevitably was going to get hit. Look, the truth is this year the impact has been felt more by tech stocks than the tech stocks, which have been impervious and been driving the whole sort of bull market for so long, are now the victims of that. So big moves there, exchange traded products. And what that also tells you is underlying that is that it's becoming more commonly used by traders, but also that there's more supply coming onto the market because there's always been an imbalance between the supply of available ETFs available for loan and the trading demand that supports it. Again, I think you see growing activity. Just a quick thing. I can't see who said this again, but look, I really appreciate this. I just want to share this from a LinkedIn user, a comment onto the commentary in LinkedIn. Thank you very much. Very kind, whoever you are. Please let me know who you are. I'll try to find out so that I can send you the check in the post. But there you go. So thanks for that. But look, let me just make one final comment here, just to give you an idea again of the quantum. So this high yield corporate bond iBox ETF from iShares generated 10.5 million, which is massive compared to the other corporate bonds there. But look, if you look at the quantum of the revenues generated, there are one, two, three, four, five stocks that generated more than that just in the US. And again, to be fair, none of the other countries had a stock that generated 10 million, but another one close at. So an ETF, even though this is an all-time record, remember this is 10.5 million, right? Out of a total of 70 million for exchange traded products, right? So this one ETF represented, so basically 1/7 of the total monthly revenue, right? Whereas stocks, you get a much wider dispersion of very high revenue generating stocks. Just an interesting comparison. So then what happened in February and into March? It was a busy time. At the end of February, the Ukrainian conflict began, and that obviously changed attitudes, views, and thoughts about what's happening in the world. So that was the end of February, started to have an impact on markets. Of course, March, you start seeing the beginning of European dividend season. And for those of you who are worried about dividend arbitrage, I have another video on that, so I'll put a link into that. We also saw the Federal Reserve, after a lot of talk, finally acted in the middle of the Ides of March, ironically. But look, interest rates start going up, so it proves the case of those anticipating interest rate rises and taking positions against corporate bonds and even government bonds. And at the end of at the end of the month, we also see the annual general meetings for Japan, which causes a shift in where securities are borrowed from. Japanese domestic investors always want to have their stocks back so that they can be listed on the register of the company. That gives an opportunity for non-Japanese investors to lend more Japanese stocks. So it's always a busy time in March. So what did the accumulation of these things do? What we saw is revenue jump by about $200 million over the previous month. And that was a rise by 27% year over year. So again, what we see is balances up again overall, and a slight revenue rise. What we in the breakdown regionally, you see America's 405 million, so up massively from January, which was in the 260 range. So that's up 77% year on. Fees up, balances up, and two IPOs that month actually hit the radar screen here, Sweet Green and Rivian. This is the real sort of specials driven activity. This is getting back to less about the hedging and more about taking positions and taking views on stocks. So that's what generates higher fees and maybe not so much imbalances, but certainly in terms of revenue opportunities. Asia Pacific, even stronger than the previous months by about $30 million, 36% year on year up. Japan being the big component there. As I said, Japanese dividends always have a big impact on the returns, and that generated 74 million. Third of the revenue from APAC came from Japan. And we see the start of European dividend season, and that's lifted Europe to almost, not quite, but almost the total of the first 2 months of the year, now delivered in the third month of the year, really being powerfully driven by Switzerland and Sweden, and then to a lesser extent by France and Germany. 2/3 of the European returns came from those four markets. Corporate bonds, another huge month, again, 100% year on year. And exchange traded products beat the record of the previous month and hitting 85 million, up 36%. And this chart, I love this, kind of shows the impact of the growth of exchange traded products, ETFs, in the sort of lending business here. You can see certainly in the US as being the primary one, a lesser extent in Europe, and then elsewhere not really having much of an overall impact. But again, those things go into the supply and demand. Exchange traded products, like the arbitrage traders and the hedge funds that use exchange traded products to take short positions, they need to be certain that there is a sufficient supply there before they're going to start doing strategies. It can be quite frustrating to actually want to put a trade on and have your prime broker not be able to source those assets. Clear quite a lot of value coming out of the US in that and hopefully elsewhere. So if you have ETFs, check out with your service provider as to whether they're being loaned out, because sometimes they can be loaned out or they aren't being loaned out because they're classified internally as funds, and funds usually aren't made eligible for lending activity. So ask the question and capture the revenue if you're not. I just want to make a comment here about US government bonds. Again, this just gives you the top government bonds for the month of March, and one Bund in there, but the rest of the US government bonds generating 77 million. So the US government's generating 77 million, all corporate bonds 73 million, and you compare that to any of the regions there. So you can see bonds drive balances maybe, but of course in the per dollar at risk return level, obviously very different figures. The highest paying US government bond that month, 6 million, just under that, wouldn't even get in the top 10 list. Okay. But again, what we see is interest rates rising. We're going to be seeing differences in currency movements. We're going to see differences in bonds. And so you'll see macro traders starting to become more active again. As far as our space goes, of course, they're always active. But in terms of competing for government bonds, that'll be interesting to see what impact that has on collateral transformation trades, the collateral upgrade trades, and what that does to fees and availabilities. Watch that space. We have a question here. Do you think the Fed signaling the reduction in Treasury issuance and Freddie and Fannie is driving bond fund activity? Look, I think that that's a fantastic question. In fact, so good, I'm actually going to show Sonia. Thank you very much for that question. Look, I think we are going to get back to a normal market environment. It'll be interesting to see whether the Fed holds their nerves or whether they end up caving, because there has been quite a lot of volatility in that market as well. And so I think what we do is we revisit this question again in 3 months, Sonia, and we'll see what's actually happening. But look, I see government bonds generating higher revenue as people start positioning themselves and we move away from the collateral transformation and those assets start competing for who's going to get access to them. So to be clear, collateral transformation trades, in my view, are going to continue to go up, but it may result in a shift of which bonds become in demand as the bonds that have been used start being used for trading rather than and position taking rather than just as collateral transformation. Okay, great question. Thanks. Oh, hold on. We skipped April. Hold on. So my mouse is a little bit too sensitive. So another April, another month over $1 billion of revenue, up 32%. Again, all of the segments, all of the asset classes were up year on year, except for ADRs. ADRs have had a tough year. It's been a miserable year for the ADR category. The truth is, I haven't really had a chance to think that through. I'm not certain why that's happening, unless people are actually playing in the home market of the securities. But don't put any credence to that, because I haven't been able to figure that out yet. Still not sponsored by Coke, but anyway, let's look at the individual countries. Again, America's not quite as strong as the previous. So with fees and balances both down, but year on year up almost 50% over the previous year. APAC, another sort of strong month. So you've seen every month in Asia has been 170 million plus. So it's a pretty strong year for Asian lenders and investors, I should imagine. Exchange traded products, another record in the 80 millions. Corporate bonds, also all-time high, an all-time high of 75 million, still up in that sort of 100% plus figure over the year. And government bonds, interestingly, down slightly on year, but up month on month. So just some charts here. Again, you see the two IPOs from the previous month. They now top the, in fact, I have a relative who's in one of those names. Hopefully his stocks are in a fully paid lending program and he's making some money from that. Old favorites like Beyond Meat and GameStop and Lucid, which I said's been on the list all year. Blink. These are mostly sort of the names, and Sirius has been on there forever and ever. The corporate bonds. I wanted to put one of the corporate bond slides up just to give you an idea of the scale of them. Look, that's not a lot of money. And despite the fact that individually none of these is very big, it's hit the all-time high. So what that's saying is a really broad spectrum of bonds that are actually in demand here. And what you can see here is these are all, three of them are non-investment grade instruments, and and two of them are private placements. So you can see that it's really on the lower quality end of things that people be playing on. And that makes a lot of sense, because what you have to remember, and maybe most of you are actually quite new or haven't been around as long. Well, no one's been around as long as me. But if you go back before we started having all of this interest rate ructions, this sort of zero interest rate, low interest rate, negative interest rate environment, high yield bonds that used to have a spread of like 10% over US treasuries. And so the reality is they have been, in my view, overpriced for so long. Like I was wrong as far back as 2016, 2017. I was trying to add corporate bonds to my lending pool because I thought they were overpriced then. I thought a normalization of interest rates would take the tide out and we'd see who was swimming naked. And I was all ready. Of course, I was years early, like years early, which means I'm wrong. But it's good to see that this is actually finally starting to happen. So broad base, higher yielding bonds being targeted in this sort of rising interest rate. Okay. Of course, the real issue is volatility, right? So the business, and I've said this before in other videos, the business makes more money when you have volatile rising market because you start getting dispersion in performance. If you just have an inexorable rising market, everything moves up and there's no real chance to differentiate. If there's volatility while it's moving up, then there's opportunity for trades in there. Secondly, if you have a volatile market and the market is falling, that's your next best environment, because again, you get volatility, things moving at different paces, and therefore there's a chance to actually pick winners and losers. Whether you're right or not, I don't know, but it does involve more shorting activity, which is good for lenders. And what we don't want is a flat market with no volatility. That's you might as well just shut your doors and come back in 6 months. But look, this is the divider. I told you that February was the game changer. We saw January have a huge spike. But look, anyway you look at it, this volatility is what's turning into a better over last year. And as an investor, if you're long only, maybe that's a problem for you. But as a securities lender, look, this is what you want to have. Okay. So this is a good condition. And let me just wrap up with the top stocks year to date. Again, this is something that the good people at IHS Market put together for me. These are the stocks. So this is the total daily revenue this calendar year. Lucid, top of the list. So you can see some EVs, an EV there, and an EV there. Electric vehicles are definitely the sector that keeps on giving. Corporate bonds playing out here and here. GameStop not going to go away. Sirius not going to go away. And then some other stocks rounding out there. But you can see why for many investors, a small number of positions might be responsible for a large portion of their revenue. Have a look at that. Hopefully that's of interest to you. And thank you to the reader that asked for this list. This list is actually what generated the idea for the rest of the show today. So, bit of a recap. January, market was driven by hedging. It wasn't specials driven. Revenues were down. But again, let me just remind you that January 2021 is a tough year to compare it to, but nevertheless, not a great start to the year. February started to get better. Rising balances, rising fees, more activity aside from the human tragedy of the Ukraine conflict. Again, we're only talking about markets here, and that starts the process for more market volatility, which generates opportunities for traders and the lenders that support them. March, obviously everything in full swing, but then the normal seasonal activity of dividends, the US interest rate rise having a huge impact, a real game changer. Because remember also what we're talking about here is it's not just interest rates rising and the impact on the trading, which I've focused on, but of course, cash reinvestment generates higher returns. And that in itself will make make more money for lenders and market participants through that. April, the growth continues, the volatility continues. I think it sets us up for quite a good year from that point of view. And the top stocks, of course, EVs, corporate bonds, and a couple of the old favorites like GameStop and Sirius. Okay, so that's it for today. As I said, next week I'm going to be moderating a panel on liquidity and trading strategy. Great group of panelists from 4 different firms. The prep session, I think there's quite a lot of interesting feedback that'll come from that. But it's just one of the panels on the day. Again, go to my community page on my YouTube channel, and you'll see where you can register for that. Hope to see you there, but I'll try to get some feedback on my own session and other sessions for the day, and give you my thoughts then. So anyway, until then, that's it. That's a wrap from me. Have a great Saturday. Have a great weekend. Hopefully a chance to get outside, and hopefully it's sunny and warm where you are, because I'm heading outside in 2 minutes to get some sunshine. Have a great weekend, and I hope to see you next week. Thanks, everyone, and